Tout le monde, and thank you for joining me for this morning's policy announcement and our monetary policy review. Our message today is threefold. First, the current surge of COVID-19 is a serious setback. With elevated infection rates and stricter containment measures in many parts of the country, households and businesses are facing renewed strains. The economy is slowing and high-contact activities are once again being hit hardest. Second, with effective vaccines now rolling out, the prospects for a strong, sustained recovery through the second half of this year have improved. And third, the Bank of Canada will continue to support Canadians and the Canadian economy through difficult times. Il y a trois points importants dans notre message aujourd'hui. Le premier est que la poussée actuelle de la cas de COVID-19 porte un coup très dur à l'économie. Avec l'augmentation du taux d'infection et l'imposition des mesures plus strictes pour contrer le virus dans bien de régions du pays, les ménages et les entreprises font face à de nouvelles difficultés. L'économie ralentit et les activités à forte proximité physique sont encore les plus durement touchées. Le deuxième point est que l'administration des vaccins efficaces étant amorcée, les perspectives d'une reprise vigoureuse et soutenue durant la seconde moitié de l'année se sont améliorées. Et troisième point est que la Banque du Canada va continuer à soutenir les Canadiens et l'économie du pays pendant cette période difficile. Before turning to your questions, let me say a few words about the Governing Council's discussions. We reviewed recent economic data. They indicate that the Canadian economy had considerable momentum through to about the middle of the fourth quarter of 2020, and extraordinary fiscal and monetary stimulus is working. In today's NPR, we estimate the fourth quarter growth at almost 5%, which is quite a bit stronger than we were expecting back in October. With the higher infection rates and higher and tighter restrictions, this positive momentum has been broken. Employment declined in December for the first time since April, and consumer spending looks to have pulled back. We're now projecting the economy to shrink by roughly 2.5% in the first quarter. And there is a risk that the severity and duration of containment measures could be extended further, and the first quarter decline could be larger. Once again, the burden of this renewed weakness is falling disproportionately on workers and businesses in high-contact industries, such as restaurants, hotels, and travel services. In the near term, the highly uneven impacts of the pandemic will likely increase. As of December, employment of low-wage workers was still close to 20% below its pre-pandemic level, while employment of other workers had more than completely recovered. And we know that the closing of in-person schooling in some provinces is making life more difficult for many parents, particularly women. Mais ces mesures sont temporaires. Quand les restrictions actuelles vont être assouplies, nous pouvons nous attendre à un fort rebond de l'activité économique. Et contrairement au premier confinement en mars, nous avons maintenant une meilleure idée de ce que nous attend grâce aux vaccins qui sont arrivés plus tôt que prévu. L'administration de ces vaccins va sauver des vies et des emplois. Governing Council spent a lot of time discussing our expectations for growth once we get past the current surge in the virus. We recognize that while the arrival of vaccines has reduced uncertainty from exceptional levels, uncertainty remains elevated. In particular, the timing and strength of the economic recovery will depend importantly on the evolution of the virus and the rollout of vaccines. Based on the current vaccine rollout plans, as we move into the second half of this year and more Canadians are vaccinated, we expect to see sustained strength in consumption and services, with services picking up from very depressed levels. This should support job creation, particularly for workers who have been most affected by the pandemic. And as we move toward broader immunity, we expect uncertainty about the pandemic to fade and business confidence to improve. This will lead to stronger business investment and exports, consistent with a more broad-based and sustainable recovery. And this will translate into strong economic growth in the second half of this year and through the first half of next. Expressed in annual average terms, we project an expansion of 4% this year and almost 5% in 2022, easing to about 2.5% in 2023. But even with this strong growth, Governing Council expects the recovery to be protracted. This reflects how far the economy still has to climb back to reach its full potential. In the NPR projection, economic slack is not fully absorbed until into 2023. Let me say a few words about the outlook for inflation. In recent months, CPI inflation has increased to near the bottom of the bank's 1% to 3% target range. We now project inflation to return to around 2% in the first half of the year, but this is expected to be temporary. The anticipated increase in inflation mainly reflects the effects of sharp declines in gasoline prices at the onset of the pandemic. And as those base year effects fade, inflation will fall again, pulled down by the significant excess supply in the economy. As we roll further forward and the economy absorbs this excess supply, we expect inflation to move up gradually and return sustainably to the 2% target in 2023. En somme, nous avons de raisons évidentes d'être plus optimistes en ce qui concerne l'évolution de l'économie à moyen terme. Mais nous ne sommes pas encore là. L'augmentation des cas de COVID-19 pèse lourdement sur les perspectives économiques à court terme. Les mesures exceptionnelles de relance budgétaire et monétaire doivent donc se poursuivre. Governing Council spent a good bit of time discussing the amount of monetary stimulus the economy needs. In view of the near-term weakness and the protracted nature of the recovery, we concluded that the exceptional degree of monetary stimulus currently in place remains appropriate. We agreed that if the economy turns out to be substantially weaker than we're projecting, leading to more disinflationary pressures, then we have options to add more stimulus, and we are prepared to use these options as needed. We also agreed that it's too early to consider slowing the pace of our purchases of Government of Canada bonds. However, if the economy and inflation play out broadly in line or stronger than we've projected, then the amount of QE stimulus needed will diminish over time. Compte tenu de ces conclusions, le Conseil de direction a réitéré son engagement à maintenir le taux directeur à sa valeur plancher jusqu'à ce que les capacités excédentaires dans l'économie se résorbent, de sorte que la cible d'inflation de 2% soit atteinte de manière durable. Selon notre projection aujourd'hui, cela ne se produira qu'au cours de 2023. Pour renforcer cet engagement et garder les coûts d'emprunt bas pour les consommateurs et les entreprises, le Conseil de direction a décidé de maintenir le rythme actuel des achats d'obligations du gouvernement par la Banque, soit au moins 4 milliards de dollars par semaine. In view of these conclusions, the Governing Council reiterated our commitment to hold the policy rate at its effective lower bound until slack is absorbed so that the 2% inflation target is sustainably achieved. In the projection we released today, this doesn't happen until 2023. To reinforce this commitment and keep borrowing costs low for consumers and businesses, the Governing Council decided to maintain our program of government purchases at the current pace of at least $4 billion per week. We will continue the QE program until the recovery is well underway. And as we gain confidence in the strength of the recovery, the pace of net purchases of Government of Canada bonds will be adjusted as required. We remain committed to provide the appropriate degree of monetary stimulus to support the recovery and achieve the inflation target. Let me stop there and turn to your questions.
Thank you, Governor. We'll go to questions now. Given the number of reporters on the call, we're going to start with one question only per reporter without a follow-up for this first round. A reminder to please mute your line if you're not asking a question. You can do so by pressing *6, unmute by pressing *6 again. Libre à vous de poser vos questions dans la langue officielle de votre choix. Pour mettre votre ligne en mode discrétion, appuyez sur étoile 6. Pour l'enlever, faites étoile 6 encore une fois. And the first question goes to Tony Mace, followed by Mark Rendell and then Shelley Hagan. Tony Mace of Mace News, go ahead.
Thank you. Thank you, Governor. I'm wondering if you see the expected pickup in GDP in 2021. Would that be enough to give the Governing Council confidence in the strength of the recovery such that you would consider adjusting asset purchases?
Tony, let me start by just reinforcing that our QE program is guided by the amount of stimulus we need to achieve the inflation target. Right now, we think the economy is shrinking, and that's going to be putting additional downward pressure on inflation. So in our discussions, we're not considering reducing the amount of quantitative easing stimulus at the current time. And as I just underlined, if the economy turns out to be substantially weaker than we projected, we have options, we have tools to add additional stimulus, and we're prepared to use those. If the economy turns out to come in broadly in line with our projection or stronger, the economy is not going to need as much QE stimulus going forward. So what would we be looking at? What we'd be looking at is we've got to get through this second wave. We've got to get we've got to get this virus under control. We need to see a rebound coming out of the second wave. We'll be watching very closely the rollout of vaccines, how quickly that's progressing, how the effect that is having on the virus, and the implications for how's that affecting the behavior of Canadians and Canadian businesses. And we will be, we'll be assessing this in the months ahead, and we'll be sharing those assessments with you. As we said in the press release, as we gain confidence in the strength of recovery, we will begin to adjust our QE purchases. I think you can, the market, you can be assured that this will be a gradual process. It's a process. It's not a switch. And we've committed to continue the QE program until the recovery is well underway. We expect a protracted recovery. This is going to take some time. We're going to need this program for some time.
The next question is from Mark Rendell from the Globe and Mail. Please go ahead.
Hi, can you hear me?
Yes, Mark, go ahead.
Great. Thank you for taking the question. I'm wondering about the inflation target, hitting the target in 2023. It seems like the medium-term outlook has improved for 2020 GDP, for the timeline around immunization. And wondering why, I guess, with improvement in medium-term outlook, the inflation expectations have remained roughly the same with the 2023 return to target. And wondering as well if that has anything to do with the revision around the potential output growth.
Very good question, Mark. Well, there's a few factors at play. First of all, we've said for some time we're expecting a choppy recovery, and unfortunately, we're in a very serious chop. This decline in activity that we're expecting this quarter, first quarter of this year, is larger than we expected. We're moving in the wrong direction right now. So the hole's going to be a little bit deeper. So there's farther to climb back out from. And yes, certainly the earlier than expected arrival of vaccines is a very positive development. And as I've indicated, we do expect to see stronger growth through the second half of this year and into the first half of next year. But we're starting off in a deeper hole, so it's going to take, we've got to climb back out of that. Secondly, as you indicated, We have made some adjustments to potential output. We do expect to see the rebound in investment come a little bit earlier. That means the economy will have a bit more capital to work with, so potential is a little bit stronger. That is a factor. And the other thing I would stress is that when we say in 2023, 2023 is still 2 years away. So we're going to learn a lot. There's a certain amount of uncertainty, and so we're not being overly precise, and that really just reflects the fact that that's some ways off.
Thank you. The next question is from Shelley Hagan of Bloomberg, and she'll be followed by Julie Gordon and then Greg Quinn. Shelley, go ahead.
Hi, Governor Macklem. This is Shelley Hagan with Bloomberg News. Did Governing Council discuss the possibility of a microcut at the meeting to 10 basis points?
Well, good morning, Shelley. Well, as indicated, we discussed how much monetary policy stimulus was needed, given our outlook. And as I've emphasized, we determined that given the current weakness in the economy, given the fact that there was we expect a protracted recovery, the considerable amount of monetary stimulus that we currently have in place remains appropriate. And as I just indicated, we also agreed that if the economy turned out to be substantially weaker than our outlook, we have tools, we have options to provide even more stimulus, and we're prepared to use them. Reducing the effective lower bound from its current level of 25 basis points to a lower but still positive number is one of those options to provide additional monetary stimulus. There are a range of other options. We could increase the pace. We could shift the composition of our QE program. Other countries have been using yield curve control. That's also an option. So we certainly do review the full range of options. And as I indicated, if the economy turned out to be substantially weaker, we have tools, and we could use those individually or in combination to provide the additional stimulus needed to get inflation back to target.
The next question is from Julie Gordon of Reuters. Please go ahead.
Yes. Oh, hi, Governor. Thanks for taking our calls. I have a moment of quiet here, so that's great. The data shows that speculators have turned net long on the Canadian dollar since December. Is that a concern for the Bank of Canada?
We did highlight in the monetary policy report that the rise we've seen in the Canadian dollar does pose some risk. In this outlook, our convention in our projections is to use the current level of the Canadian dollar. In the projection, in this projection, we've used 78 cents. That's 2 cents higher than we used in October, so that's built into the projection. And on the margin, that is dampening our exports. It is creating some headwind for our exports in the projection. The risk is that we see a further appreciation in the Canadian dollar. Today, the Canadian dollar is about 79 cents. We'll see what it is tomorrow. And if we see a further appreciation, that will become more of a headwind, and that does present some downward risk to our projection. I would underline it's important in making those assessments to understand why the Canadian dollar is moving. We don't target the Canadian dollar. The Canadian dollar is set in markets, and currencies reflect the relative price of if it's Canada-US, it reflects developments in Canada as well as developments in the United States. When the currency is moving mostly because of developments in Canada, it tends to act mostly as a shock absorber. So, for example, if the price of oil goes up, the Canadian dollar tends to appreciate. That is a bit of a shock absorber of the the benefit of higher oil prices to Canada, the improvement in terms of trade, and the appreciation spreads the benefit across Canada to every Canadian because now their currency is worth more, has more purchasing power. On the other hand, what we're seeing now is mostly most of the appreciation of the Canadian dollar is coming because of a broad-based depreciation of the US dollar. That's not a made in Canada development. So the exchange rate is becoming a factor in its own right in our projection. And as I've indicated, it will weigh on exports. It'll also, for domestic producers, it means imports present more competition to them. So yes, it is an important relative price in our outlook, and we have highlighted the risk.
The next question is from Greg Quinn of Market News, followed by Heather Schofield, and then Jordan Press. Go ahead, Greg.
Good morning. The monetary policy report mentions $140 billion of assets on the bank's balance sheet that are coming due soon, and that the balance sheet could get smaller. I was wondering, is the asset purchase program really going to be giving the same amount of support to the financial system and the economy in this kind of scenario?
The answer is yes, it will. The assets that are coming due were large. They're shorter-term assets that were bought really for the purpose of improving market functioning in the early days of the crisis. And those markets are functioning very well. We don't need, the market doesn't need those asset purchases, and we'd expect those will roll off, and that roll off will accelerate as we hit the anniversary of the darkest days of the crisis in March and April. When you look at the monetary policy stimulus, you really need to focus on our purchases of Government of Canada bonds. It's by purchasing the bonds out the yield curve that we are lowering the costs of borrowing for households and Canadians, and that's how quantitative easing is delivering monetary stimulus. That part, and you can see it in the chart in the monetary policy report, has continued to grow, and in our decision, we committed to continuing to buy Government of Canada bonds at a pace of at least $4 billion a week.
The next question is from Heather Schofield, the Toronto Star. Go ahead.
Good morning, Governor. Can you hear me?
Yes, Heather, go ahead.
That wasn't my question. How much effort do you put into dispelling myths about the Bank of Canada printing money at the behest of the federal government and Justin Trudeau to finance big spending? And are you winning that argument, and how does it play into the confidence that you need for recovery?
Well, we've been very clear from the beginning, and I think we have demonstrated this through our actions, that our purchase of Government of Canada bonds are our way in this situation where we've at the effective lower bound. They are an additional tool we have to get inflation back to target. And our use of this instrument, our purchases of Government of Canada bonds, are entirely for the purpose of supporting the economy to get inflation back to target. And this morning, as I've just outlined, we will adjust the pace and the composition of those purchases in line with how much stimulus is needed to achieve the inflation target. Back in October, we made a change to both the actual amount and the composition. That was a first step. With respect to what we're hearing from Canadians, as you know, we, as part of the inflation target renewal process, we ran a survey of Canadians called Let's Talk Inflation. We had almost 9,000 Canadians respond. And in that survey were regarding the tools that the tools to achieve the target, one of those being quantitative easing. And what we saw in that survey was there was broad-based support for A, having the Bank of Canada have an inflation target, and B, using quantitative easing as a means to achieve that target.
Thank you.
So we will, and I'll just add, we will be, I've seen the preliminary analysis of those, of that survey. We will be publishing the analysis of that survey, so you'll all get to read about it.
Next question is from Jordan Press of Canadian Press, followed by Kim McCrail and then Pete Evans. Go ahead, Jordan.
Good morning, Governor. I'm not asking you here to be an epidemiologist, but as the head of the central bank, when you're talking about vaccines and the delivery of them, I'm curious as to what you see are the risks that may come from people not wanting to take the vaccines. What are the economic risks if there are a number of Canadians who decide not to take the COVID-19 vaccines and maybe delay the broad immunity that you're looking for by in the coming months?
Jordan, the earlier than expected arrival of vaccines is a very positive development, and it really shows real promise of better times ahead. As you've indicated, it's going to be very important that Canada get the vaccines, we get them distributed to Canadians, and the Canadians take the vaccine. The effectiveness of monetary and fiscal stimulus, for that matter, is going to increase as Canadians can get back to more normal activities. As Canadians regain confidence that they can get back to more normal activities, our stimulus will have increased traction. And we've been very clear in our baseline forecast that it is predicated on successful rollout of vaccines, that goes reasonably well. And as Canadians get vaccinated, we are expecting to see a strong rebound in economic activity through the second half of this year and into the first half of next year. Yes, the forecast is highly conditional. The timing of the forecast is highly conditional on the rollout, the effectiveness of those vaccines.
Next question is from Kim McCrail. Go ahead, Kim.
Hi, thanks, Governor. I'd like to pick up on your response to Shelley's question about a possible microcut. I think you said in your response that reducing the effective lower bound from the 25 basis point level to a lower but still positive number is one of the options to provide more monetary policy stimulus. I just want to ask you, are those two concepts intrinsically linked, or would the Bank of Canada consider reevaluating the effective lower bound independently, regardless of a decision to actually proceed with a microcut?
Well, the markets are, Kim, markets are working reasonably well now. In fact, they're working very well. So we're not focused on issues around market functioning. We're very focused on providing the amount of monetary policy stimulus that we need to support recovery and get inflation back to target. So in that vein, reducing the effective lower bound to a lower but still positive value, that would be a way, possibly in combination with other tools, to provide more stimulus if that were needed. So in that context, that's as a monetary policy tool, that's the way we see it. If we were to get back into a situation where there was more market turbulence, that would be a different kind of discussion.
Thank you. The next question is from Pete Evans of CBC. Go ahead, Pete.
My question was on QE, but I got the answer I was looking for already, so thanks, I'm good.
You're welcome.
All right, so we'll go to Kevin Carmichael, followed by Dave Parkinson, if we have time.
Good morning, Governor. wanted to ask quickly about an assumption in the NPR, and that assumption being that the tremendous amount of household savings that we've seen accumulate through the crisis will go unspent. Could you elaborate or explain why you're assuming that households will either hold on to that money or use it to pay down debt rather than deploy it once conditions change?
Well, Kevin, we've tried to be very clear about the assumptions, the hypothesis we've made that underlie our projection. With respect to that assumption or that behavioral projection, so as you indicated, one of the unusual features of this recession is that we've seen a big increase in savings. And that's particularly for households in the top half of the income distribution. And that appears to be mainly because a lot of the things that middle and higher income households buy, they can't do. They can't go to restaurants. They can't go to movies. They can't travel. So as a result, they're not spending that money. Now, they've substituted some of that spending that they would normally spend on high contact services towards more goods purchases, and that's certainly been supporting the economy. And what we're assuming is that as vaccines are rolled out, people can get back to more normal activities. They will resume consuming more services that they want to consume. But you can think of them a little bit about like haircuts. If you don't get a haircut, I could use one pretty soon myself. If you don't get a haircut, when you go back to getting haircuts, you don't get extra haircuts. You just get back to getting the same number of haircuts you got before. And so as we see those services coming back, for many of them, yes, there may be a little bit of catch up, but we're expecting that people will go back to their more normal spending patterns, but the extra money that they've saved while they haven't been making that spending, most of that will be used to either pay down debt or invest it. One of the reasons we've made that assumption is that we have a survey of consumers, and when we go and ask them what they're going to do, that's what they say they're going to do. There is a risk, and we highlight this in the monetary policy report, that they could actually decide to spend more of that savings. And if that happens, you expect to see even stronger consumption growth than we have in the projection, and we'd get back to the economy to full potential faster. That would be a good thing. We've made a conservative assumption, I would say, in the projection.
All right, we have time for just one more question, and so that will go to Dave Parkinson of the Globe and Mail. Go ahead, Dave.
Oh, hi, Governor. As a sort of a natural follow-up to what Kevin was just asking you about, the NPR didn't really say anything about the buildup of corporate cash. Obviously talked about consumer cash, and you've just covered that off. But I'm wondering how you interpret the buildup of cash on the corporate balance sheets, and how that might affect maybe if there is an upside risk there to the business investment outlook.
Well, let me begin by emphasizing in the corporate sector, like the household sector, there's a lot of unevenness. So it is a little bit difficult to draw broad conclusions. You've got some firms, particularly some companies, some businesses, particularly in high contact industries that are really hit hard. They're really suffering. The oil and gas sector is also quite weak, and we're expecting a pretty slow recovery there. You are seeing other businesses, though, that are doing better. And as you indicated, many businesses have built up cash buffers. We think that is largely for precautionary purposes. They want to make sure that they can be resilient to the kinds of setbacks we're experiencing right now. But as you've indicated, those firms there are a significant number of firms that do have a fair amount of cash. Credit markets are also open. Interest rates are extremely low. So there is ample access to funding once firms come to a view that they have the confidence to invest. With respect to investment, I will say, again, we're seeing a real divergence. In our own Business Outlook survey, about 20% of firms told us that they're actually increasing investment right now. That's mostly around digitalization. What we're expecting is that as vaccines roll out, as confidence improves, firms will begin to invest more, and it'll be at that time that they deploy that cash, and we also may see an increase in corporate credit around that time. Thanks very much.
Thank you very much. That concludes today's press conference. Thank you, Governor Macklem, and thanks to everyone for joining us today.